Every 6 weeks, the Fed's Open Market Committee meets to make a decision that will impact the lives of every citizen in the country. By the end of their meeting, they will have evaluated the economy and decided whether to increase or reduce the money supply. These decisions will tend to either speed or slow the economy and reduce the possibility of inflation or recession.
The Federal Open Market Committee, or the FOMC as it's usually called in the financial press, reviews the state of the economy, the state of financial markets, how the money supply has been behaving, how interest rates are behaving and foreign exchange rates, and so forth. And then it makes a decision about the stance of monetary policy until the next meeting.
Despite strong growth, Federal Reserve policymakers left interest rates unchanged today. One reason is apparently Fed Chairman Alan Greenspan's stated belief that workers aren't asking for raises because of job insecurity.
While it targets short-term interest rates, the ultimate target of the Federal Open Market Committee would be the growth of the money supply. And basically the idea there is to keep the money supply growing in tandem with the ability of the real sector of the economy to grow. At our meetings of the FOMC, we make these decisions and then we notify the Federal Reserve Bank of New York, which acts as the agent of all the Federal Reserve banks in carrying out monetary policy. And they do that primarily by buying government securities in the open market or selling government securities in the open market, hence the term Federal Open Market Committee. If the FOMC decides that the economy is slowing down too much, it would basically do things that would speed up the growth of money and or put downward pressure on short-term interest rates, which would have that effect. What that means is that it would buy more government securities in the open market to create bank reserves. On the other hand, if the FOMC decides that the economy is about to overheat, or if there are signs that inflation is about to build up, then it will undertake to slow down the rate of growth of money, usually through putting some upward pressure on short-term interest rates. But it would become a less aggressive buyer of government securities over a period of time.
Bank operations are affected by really two principal monetary controls of the Federal Reserve System. The first one is something that the Fed calls the discount rate, and it is the rate that they will offer to buy and sell discount rate related funds to banks or from banks. Those are generally called Fed funds, so they will allow a bank to make an investment of Fed funds at that rate, or they will lend the bank money at that rate. The other way that the Fed controls monetary policy is through reserve regulations. The reserve requirement is the amount on a percentage basis that the Fed requires a bank to keep unlent and uninvested of every deposit dollar that they receive. The bank has to maintain a certain amount on reserve. They're not allowed to lend it. They have to keep it at the Fed.
Without the Federal Reserve's close scrutiny, America's supply of money and credit, left unregulated during periods of recession and inflation, could capsize the nation's economy. The Fed maintains the nation's infrastructure for check collection, provides the public with fresh currency, and watches for counterfeiters. But controlling the money supply is the Fed's biggest responsibility and its greatest challenge.